Today we are going to discuss on the investment. Investment is actually one of the most important aspect of the business activities because it is directly related to the core value of the business, and also it is directly related to the long-term aspect of the business. Uh, in other words, the sustainability. It is directly related to the profit maximization, which is the goal of all of the business activities. More specifically speaking, we are going to discuss on the net present value analysis as an investment rules today. Uh, so we we are frequently facing broader issues like whether or not we should launch a new product or enter a new market. So decisions such as these will determine the nature of the firm's operations and products for the longer term period. So for these reasons, the capital budgeting question is probably the most important issue in business management, particularly for the international business management, where a lot of investment opportunities in there. So, so starting on the investment rules is one of the quite important subject for the study of international business management and the finance. So today I will cover many of the investment rules, including the net present value analysis and investment payback rule and like internal rate of return analysis. So you will study on these different categories of investment, the rules, and you can compare those rules with which is the advantage and which is the disadvantage of the individual, you know, uh, criteria of investment, you know, value analysis. All right. So first, I will going to discuss about the net present value, and then to move on to the payback period method, and more on the payback method with the discounted payback period method, and then moving on to the average accounting return method, and are starting on the internal rate of return, and touch on the what is the problems with the IRR approach, and briefly talking about the profitability index, and finalize with the practice of the capital budgeting in the market. So net present value analysis. So many people argue that the goal of the financial management is to create a value for the stockholders. So a financial manager must therefore examine a potential investment in light of its likely effect on the price of the firm's shares. So for this purpose, we we are widely using the net present value analysis. So what is the net present value? Net present value actually is defined by the total present value of the future project cash flows less the initial investment. In other words, is the total present value of the stream of cash flows minus the cost of initial investment. So couple of points we need to keep in mind that first estimate future cash flows, how much and when. So we need to identify. And then we need to identify the discount rate. What is the required return of the project or the product? And third, we need to estimate the initial cost. So in general, the minimum acceptance criteria for the project or the new product line will be like this. You can accept if the net present value is higher than zero. In other words, you can accept the new project if the net present value is positive. Or if you have some multiple projects, multiple new project opportunity, you can compare the MPVs of individual project, and then you can rank the criteria, and you can choose the highest MPV as the most profitable opportunity of the investment. All right, let me discuss about the MPV with a very short example. Let's suppose that there is a company named Big Deer Corporation. This company has an opportunity to make an investment of 100,000 that will return in year one $33,000, and year two $38,000, and year three $43,000, and year four $48,000, and finally in year five $53,000. What if the company's return is 12%? Should you make the investment for this project? This is the question. All right, just look at the table, on the slide, and just think about that. How do you respond to this proposal? How do you respond to these cash flows? Let me have your answer. Just thinking in a minute. All right. You have tables. You have cash flows. So on right rows, you can get the present value of the cash flows like that. So so net present value is just a summation of present value of the cash flows, including the initial investment. In this case, 100,000 US dollars. So net present value will be 5943. So answer is yes, because the MPV is greater than zero. The 5,943, US dollars. Therefore, your investment is quite is too worth to invest. You have a return, at least the required rate of return. In this case, you 12%, right? Your investment brings you with the return is higher than 12%. So in other words, NPV is positive, is higher than 0. So you can make this investment. This investment is bringing you, this positive value. All right. So let us just thinking about why we, consider the NPV whenever we have we need to make a decision about a new project regarding the whether or not accepting the new project or not. Because, accepting positive net present value directly, you know, brings you the benefits of the positive benefits, you know, for your shareholders. There are many benefits, many advantage of using NPV as a investment rule, because first of all, NPV uses cash flows, not accounting data. We just the NPV use the actual cash flows. Also, NPV uses all relevant cash flows of the project. Also, NPV discounts the cash flows properly with the appropriate, rate of returns. So, and also the NPV rule assumes that all cash flows can be reinvested at the discount rate. So on the bottom, you can see that the formula of the present value is the cash flows divided by discount rate, and this formula shows you how to calculate the present value with a compounding method, not simple method. So this means that cash flow are reinvested at the same discount rate over and over. So this is exactly the compounding method. All right. Next, you can calculate the NPV with the spreadsheet. Let me show you how to calculate the NPV with the spreadsheet. So just we have a, NPV function on the Excel. So you can calculate NPV like this. Just put the cash flows, the year 0. The cash flows for the initial investment, and year 1 is the first cash flow, year 1, and year 2, the second cash flows for year 2, year 3, the third cash flows for year 3. So you can just put the numbers of the cash flows, and then like and then you can put the required return. In this case, the 12% is required return. So and you can put the NPV, the function, and you just cover the cash flows from the year 1 to year 3. You can see that there is the two different types of NPV, the incorrect NPV and correct NPV on this spreadsheet. Which means the incorrect NPV means the covering the cash flows from year 0 to year 3. This is incorrect. Forgetting the correct answer, correct NPV, you need to the cover from year 1 to year 3, and then sum up with the initial cash flows year 0. So you can see on the spreadsheet with the function, the spreadsheet function, how to make the difference between the NPV correct and the NPV correct. So just be cautious to get the NPV correct. Just covering from year 1 to year 3, and then sum up with the initial investment year 0. Please check with the spreadsheet on the slide in a minute. Again, to get a correct NPV on the spreadsheet, you need to cover the range of the cash flows beginning with year 1, and then add the initial investment after computing the NPV. All right, please check. All right, next. Moving on to the next investment criterion, we are going to discuss about the payback rule, payback period method. So this is actually very similar, but is different from the NPV rule, because it is more focused on the how long does it take the project to pay back its initial investment. So payback period means the number of years to recover initial costs. And you can set the minimum acceptance criteria. So it is kind of, very arbitrary criteria, because you can set by your management team, so any number, any years you can set as a acceptance criteria. So for the ranking criteria, you can set by the management in the same way. So more often, I mean, the shortest payback period is preferred. So if you have multiple choices, you can choose the shortest the project with the shortest payback period. Right, let me show you the example in the later slide. And let me discuss the first advantage of the payback period. Is very easy. It's very easy to understand, and the bias towards liquidity, because this often the shortest payback period is preferred, which means this is more liquid products, more liquid project will be preferred. So biased toward liquidity. And also this payback rule has a lot of disadvantages. I mean, one of the most fatal drawback of the payback rule is that they ignores the time value of the money. Right? We have discussed NPV. For the NPV rule, we just consider the time value of money, but payback rule does not consider the time value of money. It ignores the time value of money. This is very fatal, the shortcoming of this rule. Also, it ignores the cash flows after the payback period. Just to calculate the payback period. and then ignores the cash flows after that point. So this is one of the disadvantages the payback rule, contains. Also, it is biased against the long-term project. We have just discussed that the shortest payback period is preferred, so it is basically against long-term project. And another disadvantage for this criteria is that it requires an arbitrary acceptance criteria. This is very arbitrary. And for the NPV rule, we have criteria as a zero. As whether what NPV is positive or negative. But for the payback rule, there is no clear criteria. Just you can set. Just it depends on the management, the preference. So it is very arbitrary acceptance criteria. So this is quite a disadvantageous. Right? So let me discuss about example of the payback method. You know, let's consider a project with an investment of 50,000 and cash inflows in year one, 30,000, and year two, 20,000, and year three, 10,000. You know, so with these, stream of cash flows, the question is, what is the payback period? How long is the payback period? You know? Just it is very easy. You can calculate the payback period. In a just in like 30 seconds. So 2 years, because year one 30,000 and year two 20,000. So you can cover the 50,000 of the initial investment in 2 years. So for this case, the payback period is exactly the 2 years. All right. However, it is not necessary. It's always there is a single payback period. Just let's see this example. There is a project A and another project B. So the cash flows of the project A is like initial investment 200, and year one the cash inflows at 200, year two cash inflows at 800, year three cash outflows 800. For project B, initial investment 150, year one cash inflows of 50, year two cash inflows of 100, year three cash inflows 150. So what is the payback period for those two projects, project A and project B? Just calculate in 10 seconds. All right, for project A, the payback period is 1 year or 3 year, right? So there are multiple payback period for project A. For project B, the payback period is clearly 2 years, right? So there is a single payback period for project B. But project A got a multiple payback period, which means, it's very confusing. If you use the payback period as investment criteria, so you can face this kind of very difficulties. I mentioned that the payback period have a very serious drawback because they do not consider the time value of the money. So how to recover, how to overcome those the problems with the payback period. We can modify the payback period method, like a discounting payback period method. So just it is the same concept of the payback period rule, and then just taking the time value of money into account. So this rule is the same. They accept the project if it pays back on a discounted basis within the specified time. So, and one of the advantage of for this analysis, this criteria is that by the time you have discounted the cash flows, you might calculate the NPV as well. So this is kind of consideration of the NPV into the payback period method. So let me show you an example for the discounted payback period. Suppose the same company of the big deal corporation has an opportunity to make an investment of 100,000, and it will return like 33,000 in year one, 38,000 in year two, 43,000 in year three, 48,000 in year four, 53,000 in year five. So, and the company's required return is 12%. And this company just, set the uh, criteria of the payback period as 3 years. So should you make the investment? This is question. Please look at the table and then make your decision based on the discounted payback period rule. All right. All right. So on the left row of the cash flows shows you, just the nominal cash flows. And, in the middle of the cash flows is the present value of the cash flows. You can calculate the present value of the cash flows for each year. So like B, and then you accumulate the present value of the cash flows, and you can see that, between the 3 years and for year three and year four, you can have cumulative present value like 0. So, you know, based on the discounted payback period, right? So answer is no, because the predetermined payback period is 3 years, and the discounted payback period is like between 3 and 4 years. So it is longer than predetermined payback period. So you did not invest for in this project. At the end of 3 years, the project still has negative payback, negative cash flows. So it must reject it, right? And just look at, you know, circle A. I mean, if you just use a simple, just a simple payback period method, what is the difference? You know, payback period, you know, probably lies in between year 2 and year 3, you know, because some of the sucker of A is, you know, recover the initial investment. So, I mean, this is the difference of using the discounted payback period and the simple payback period, all right? So discounted payback period is more accurate than the, just the simple payback period. All right, let me move on. The average accounting return method. This is another investment criteria, but it is also fatally flawed, because mm, most importantly, this approach are using the accounting numbers, not cash flows. So that is the most fatal, this advantage for this approach. But it is in reality, many of the financial managers are using this criteria as the investment rule. So you need to refer to this criteria as well. So let me show you the example. This table is the projected yearly revenue and cost for average accounting return. So suppose that this company are deciding whether or not to open a store in a new shopping mall. The required investment in this, you know, the location in this shopping mall is 500,000. And, you know, this investment, let's assume that this investment just can live in 5 years for 5 years. So the depreciated every year like 100,000 by the straight line, the depreciation method. So in this case, what is the average, you know, accounting return for this project? So you can calculate the average first average net income. Uh, you can see the net income year one, 100,000. From year one, 100,000 to year five, minus 50,000. So you just plug in the number of net income in a nominator of the average net income and divide it by 5. So you can get average net income of 50,000. Also, you can get average investment like I mentioned that 500,000 initial investment is like it will be you live for 5 years. So just average investment is like 500,000 divided by 2 is the 250,000. So you can get a AAR as a 20%. So if your company set the predetermined criteria of the AAR less than 20%, you can accept this project, right? Because it is higher than the predetermined return. All right, let me tell you about the advantage and disadvantage of the AAR. The most favorable aspect of this criteria is that it is very easy to get the accounting information. You know, the accounting information is always, you know, uh, with us, so we can get that information from any kind of database. So it is very easy to calculate. But AAR has a lot of shortcomings, like it ignores the time value of money, and also it uses an arbitrary benchmark cutoff rate. And more importantly, it is using the book value. In other words, the accounting value, not you know actual cash flows, not market values. So it is less a variable in terms of financial variation. So, but AR is one of the very popular criteria, but because you know mainly because of it is the very easy access for the data.